Today's podcast is brought to you courtesy of our friends at Tuttle Capital, who not only create defiant ETFs for the market, but help investors choose better, navigate smarter, and rest easier. Tuttle Capital, the antidote to Wall Street.
All right, joining me is Thomas, Chief Commercial Officer at the Jito Foundation, who very simply, the Jito Foundation helps facilitate the growth and awareness of the Jito network, which is a decentralized Solana-based protocol that allows users to stake SOL, and then they receive a liquid staking token, which is JitoSOL. We will get into all of this in more detail in a moment. I should also note the Jito Foundation manages the Jito DAO as well. Now, Thomas himself, we are talking about somebody who is highly fluent in both TradFi and DeFi. So he actually spent over 2 decades at Jane Street Capital, where he most recently served as head of institutional crypto. So that should give you a pretty good idea of the expertise that he's bringing to the table. And so, Thomas, thank you for joining me. Great to connect.
Oh man, I'm very excited to be here. It's nice to run into ETF people in crypto.
Well, I always feel the same. It's nice to run into people in crypto that have a TradFi background. So this is perfect. So let me ask you this: did I describe everything properly there, just at a high level in terms of the Jito Foundation and the Jito network? I guess tell us a little bit more about what you do.
Sure. So Jito, the way that I see it, Jito has 3 major verticals. One is Jito is a core Solana infrastructure provider. And so previously or historically, Jito Tips was the primary way that users could get transactions to land. So if you wanted to be an early mint, or if you had a bundle of transactions that you didn't want sandwiched or broken up, what you could do is you could submit that bundle, or you can submit that transaction and add a Jito tip. Jito takes, and so it kind of moves it into kind of a higher space in the queue. And so Jito accounts for over half of Solana's REV. Jito takes the tips and distributes it back to validators, who returns it to stakers in the form of kind of increased yield. So it's part of the reason why Solana's yields are where they are. And just to give you some context on that, like I think over the course of 2025, Jito will have distributed in excess of 1.2 billion back to validators. So it's a very substantial part of Solana's infrastructure because of Jito, the network is more performant. There's less spam. There's reduced latency, things like that. We've upgraded or provided a new system called BAM that was rolled out a couple months ago. It's still in testnet, but it essentially allows app users to create apps that control their own sequencing. It is a potentially very, very powerful tool. We'll see how it is implemented, but we're very excited about that. Another major vertical of the firm is restaking. So for those of you who are familiar with Ethereum, it's like a Solana version of EigenLayer that's growing very, very quickly. And the third vertical is the one that I spend most of my time on, which you've referenced, which is the liquid staking token.
And on the note of a liquid staking token, my goal with this podcast, Thomas, I don't always want to assume that everybody knows everything. And so if you don't mind, can you just explain what a liquid staking token is and what some of the use cases are? How do you like to describe this?
Sure. So liquid staking tokens are basically deposit receipts that demonstrates ownership over a certain amount of Solana that has been staked, plus the rewards that stake is entitled to. And so, I think when the SEC released guidance on liquid staking recently and concluded that liquid staking is not an activity that requires registration as a security, what I thought was intriguing is that Commissioner Peirce added a follow-on statement that she called the staking sequel, and she talked about liquid staking as kind of a new solution to an old problem. And so essentially the idea is, in order to participate in the security of the network, like stakers are incentivized to provide stake to validators. But what ends up happening is that if you stake to a validator, in the old model, like the stake was just kind of stuck there and it was working, but if you wanted it back, you needed to kind of unstake. Now, what liquid staking does is it actually creates a pathway where the ownership has been released, and now you can use that demonstration of ownership to kind of post as collateral, or you could borrow against it. One way that, from a TradFi perspective, like one way to think about it is, how do you release liquidity for products that are hard to move? And so a kind of an easy example of that is, if you're trading spot gold with a bank, you're not actually trading physical gold, you're trading unallocated receipts. And so and so you don't actually have to physically move gold. You're just actually trading this this evidence of ownership. But for more, I'm going to try out a new line of inquiry here, and this is particularly relevant for, we're trying to do the translation to TradFi, and one example, some of these concepts are like tricky for kind of TradFi people to understand, and so one way that I am thinking about describing it is. So my mom, she has a bunch of money. She constantly asks me what she should do with it, and she ends up parking it in CDs. So CDs, certificates of deposit, are a solution that banks have developed because, banks fundamentally have this duration mismatch problem. They borrow short and they lend long. And so the banks are willing to pay more for deposits if you're willing to kind of commit to parking them for 9 months, 12 months, something like that. But the problem is, if you need that capital kind of midway, like, you need to replace your roof or something like that, like you give up all of your returns. Whereas if you can actually just, trade it with somebody and it has the interest baked in when you trade it, it's actually good for the user, the investor, because they get access to their capital right away. But it's also good for the bank because the bank still has the deposit that is kind of time locked. And so, I think that, this is something that is already on industrial scale. Like, this is just dirty bond pricing. But I think that liquid staking tokens are a way for you to increase the velocity of transactions for products that are already locked up. And in terms of use cases, I think that there's a lot. And since we're on an ETF podcast, like, the way that I'll describe it is that liquid staking tokens actually share a lot of the features of ETFs, in the sense that they provide economic exposure to an underlying asset, but they abstract away all of the ownership, like responsibility. Like, you don't have to maintain it. There's no technical or operational maintenance. You're just holding it within this actual token that you can kind of move freely. There's primary and secondary market liquidity, like you can create or redeem the tokens by using Solana, and that kind of increases like this liquidity flywheel. And it's also tax efficient, we believe, because of this in-kind creation and redemption mechanism, which has always been like a secret power of ETFs in the ETF structure. So
yeah, and as we sit here today, liquid staking tokens, those are the dominant model for participating in proof of stake networks, correct?
Well, weirdly, so the market share of liquid staking tokens on Ethereum, which is where they were kind of created, and where I think that the use case for liquid staking token on Ethereum is very, very different than Solana for a couple of key reasons. But if you look at the actual amount of Solana that's staked and how much of that is held in liquid staking tokens, it's actually a relatively small percentage. So I think that the liquid staking as a percentage of total Solana stake is still only like 13.5%, 14%, something like that. So there's still a very, very large opportunity for liquid staking to kind of take hold. And that's part of what we're trying to do, is increase the flexibility for Solana holders.
And you were alluding to this, but again, I always like to cover the basics. Do you mind just explaining proof of stake? I mean, that ties into what's going on here. I know that's a very basic concept, but I think it's helpful for people to understand. I know I say basic, you can get way down the rabbit hole.
Yeah. So, yes, and I do a much worse job than I probably should on describing this. But essentially, so proof of is just like a lead in to what is a blockchain's like consensus mechanism. Like, how do they determine what is the correct state of the blockchain? And so you have Bitcoin, which is proof of work. And essentially what that means is in order to create the next block, miners are competing with each other to solve these like mathematical problems. And the first one to solve the problem gets the right to kind of create the next block. The way that the proof of stake works is that the leader slots are determined based on some kind of probabilistic allocation of responsibility based on the amount of stake that you have. So if you have a large stake, you are more likely to be the leader and can generate the blocks than if you have small stake. And so the distribution of stake is very, very important. And Jito, we spend a lot of time actually trying to balance stake between as many validators as we can. So right now, the way that StakeNet works is we allocate it between 200 validators. We're quickly going to increase that to 400. And that's, there's a lot of benefits to that. Like it keeps the networks decentralized and actually balances load kind of geographically, which is very, very important. And because, distributed systems like Solana does have this problem where, one leader might be in South Africa, the next leader might be in Japan. And so, this whole idea of getting as close to the matching engine as you can just doesn't work in a distributed system like Solana. And so that's one of the reasons why market structure is like so difficult for TradFi people to understand.
Okay, so I want to start heading down the path towards talking more about JitoSOL itself and in the recent ETF filing. And I'll tell you, Thomas, I think for many on the TradFi side, JitoSOL first popped up on the radar a few weeks ago when VanEck did file for this JitoSOL ETF. I think some people thought this was like a meme coin ETF or something. They just weren't familiar with JitoSOL. But look, I know
searches for JitoSOL went up.
yeah. But I know you have been instrumental in working behind the scenes to help bring this ETF filing to fruition. And we can talk more about the filing itself here in a moment. But do you want to take us through some of the work that you've been involved with here? Again, you were actually alluding to this a little bit earlier as well, but you have helped here on the regulatory front, and I'd love to have you talk about some of that behind the scenes effort.
Sure. I mean, for the regulatory side, I have to give all the credit to Rebecca Rettig, our CLO. Like, she is just an absolute titan when it comes to kind of regulatory compliance, and she is the reason why Jito was the first, I think, private company to meet with the SEC back in early February when the task force started meeting with companies. And so a lot of the work that was done was actually very honestly done before I got here in terms of laying some of the regulatory groundwork. Just to give you some context, so I joined Jito officially in early April, but I left Jane at the beginning of the year. And my plan was actually to just chill out and take some time off after 22 years of nose to the grindstone. But I talked to Rebecca in late January, and she alluded to this project that they wanted to work on, which is how do you get the liquid staking token involved in the conversation around ETFs? And having been at Jane, I was like, oh, well, I can tell you why it's such a hard problem to try to solve. And then once I started working with them and meeting the team, it's a very, very compelling group of people to work with. And so, the main issue that you have is that a lot of people focus on the issuer when it comes to these things. But in order to add any sort of new asset into an ETF, there's a whole ecosystem of service providers that need to be on board. And so, you need, because it's an ETF, you need to have qualified custodians. You need to be able to generate an index price in order to calculate an NAV. So you need index providers involved. You need APs who can actually touch the product. That became a big issue, for instance, last year when the Bitcoin ETFs launched. There's a big reason why these are cash creates and redeems is because some of the first suite of kind of APs couldn't actually touch physical crypto. You have to get the LMMs involved and everybody else. And so, one of the things when I started talking to them about the ETF kind of product or project is, well, there is this whole kind of waterfall of service providers that we need to get in touch with. And, one of the first things was like, in order to generate an index price, you need centralized exchange, like price discovery. And at that point, like JitoSOL was and remains the most liquid staking token on decentralized exchanges, on DEXs, but it didn't have a SEX listing at that time. And so, like, a lot of our SEX listing strategy was primarily geared towards, well, how do we actually target the exchanges that matter for index providers? And so that's why, the SEX listings today include Coinbase and Kraken and Bullish and Gemini, because these are all good exchanges for index providers and constituents. And so, we're fortunate in that, Rebecca and Lucas laid the groundwork on the regulatory side. We were already talking to some of the custodians, the key custodians, like Anchorage, which is a federally chartered bank, supported JitoSOL back in July. And so this is all kind of, there's lots of steps to get here. It's one of those things where, overnight successes take kind of a long time to build. And very frankly, like, when we started talking about this, I was like, this is a very ambitious project. It's probably going to take potentially years to get. And here we are, like 5 months later, and we're on the precipice of like a bunch of Solana ETFs launching next month. So,
were you surprised at the SEC guidance that you mentioned earlier that they clarified that certain liquid staking activities were not securities? Like, the regulatory environment has just shifted so quickly. And you mentioned the discussions that have been going on for a while now. Did the timing of that surprise you at all, or did it make sense based on the conversations that were happening behind the scenes?
The timing wasn't. So I agree with you. Like, when I left Jane, I was very much of the opinion that, regardless of what you think about the security status of any token, like a liquid staking token sort of just has to be a security under Howey because of, common enterprise and efforts of others and things like that. But, Jito was very insistent from the beginning, particularly in the meeting with the SEC. And the SEC was the one who pointed out that actually JitoSOL, because of its structure, because stake is delegated autonomously, there are no actual efforts of others. Everything is done via code. And so JitoSOL, we thought with a pretty high degree of confidence was not a security even from the outset because of the way that it was designed and because of the focus on decentralization, which is kind of runs throughout the entire organization. But once the SEC released guidance on staking activities, we thought that guidance on liquid staking was probably not too far behind. And I agree with you. I mean, the the shift in attitude, like you can't even describe it in any sort of, there's no metaphors that can adequately explain like the speed and the size of the shift that's taken place.
I agree. I have a hard time verbalizing it as well, just because anybody who has been in the crypto space or at least tracked the crypto space for, say, more than a few years, it's almost hard to fathom where we're at today versus where we were at even a year ago. But certainly if you go back a few years, the regulatory shift has just been mind-boggling. So let me ask you this. With a 100% liquid staking token ETF, like with what was filed for on the VanEck JitoSOL ETF, can you explain the benefits here and how this would compare to an ETF that holds just spot Solana and perhaps engages in staking? So,
Sure.
We have a number of filings out there right now for what I'll call just traditional spot Solana ETFs. We're still waiting for the SEC to approve staking within the spot Ether ETFs, but theoretically, if that's approved, that would also be approved within spot Solana ETFs once those come to market. So how does a 100% liquid staking token ETF compare to those products?
Sure. So first and foremost, I think that the biggest hurdle that remains to any sort of staking product is the IRS. The IRS still hasn't released any guidance as to whether or not staking is going to be permitted within a grantor trust. And if it's not permitted within a grantor trust, then a lot of these issuers are going to have to either decide whether to have unstaked products or to convert to like a partnership or a corporation, which is kind of worse from a tax perspective or problematic for users. No one wants K1s on a partnership ETF. So, but assuming that staking is going to be approved, I think that there's a few things that are relevant when discussing like an LST ETF versus like just a staked SOL ETF. So first and foremost, like I think if you're starting from scratch, like first principles, like what is the best product for an investor? I think you have to conclude that 100% staked product is just better from an investor standpoint because it maximizes the achievable yield. But the big problem for issuers, or the big kind of balancing act that issuers have to take, is how do you manage redemption requests if the entire fund is fully staked? And so from a user perspective or an investor perspective, like a JitoSOL ETF should just get more yield because 100% of the fund is by definition fully staked. And I think it should be the lowest cost, mostly because like the fees that the Jito Foundation are charging on JitoSOL should just be better than like somebody who is actively managing a staking provider service. There's lots of kind of side deals. We don't actually know what that's going to look like, but from an investor perspective, that's like kind of the starting point. You're going to get more yield and you're going to pay less for it. I think for the issuers, there's a bunch of different benefits to having an LST ETF than a staked Solana ETF. And so first and foremost, like it's just easier. Like if you hold the liquid staking token is a total return product. So the yield compounds within the product. And all you have to do is hold the staking token. Like you don't need to have any sort of additional operational or technical infrastructure. You don't need to do things like reconcile reports from staking providers and make sure that they're paying you and doing all that stuff. All you have to do is hold the token. There's also a benefit to that because if you're an AP and the ETF is getting some off-chain yield, like you don't actually know how that yield is accruing within the ETF. Whereas if you have a fully transparent like index component, like the PCFs are just much, much cleaner if you have just this 100% LST. And so there should be less kind of error bars in terms of what the ETF is worth on a daily basis because you know exactly what it's holding. The liquidity on redemptions, especially if it's done in kind, you don't have to wait for unbonding periods. You just receive the LST. And there's questions around the liquidity around LSTs, and I'm very happy to kind of go into that. But yeah, it should be the most transparent, and it should be kind of the easiest for an issuer to maintain. But there's also like this tertiary benefit, which is to the Solana ecosystem itself, which is that because of the way that JitoSOL distributes stake, if you stake with JitoSOL, it gets spread out across the entire kind of validator universe in a way that improves or enhances the decentralization of the network and also increases the security of the network because the stake is distributed kind of in a much more equal way than just kind of getting aggregated into a single validator. So to be very, very clear, any staked Solana ETF is better than nothing. And, one of the things, so there was the most recent round of amendments on the Solana S1s came out on August 29th. So VanEck has included liquid staking token from the outset. 21 shares included liquid staking token assets as liquid staking token as a potential solution in the second round of amendments. And the big update in this most recent round is that Fidelity has added language around LSTs. And so, I think we are making progress. The guidance, the SEC's guidance on liquid staking came out in early August. And I think ultimately, we will see liquid staking tokens in an ETF in one form or another. But even if you just have a stake Solana ETF, like it's just going to be a better product for users than a lot of the stuff. Sorry. The other thing to mention is that JitoSOL is already included in a stake Solana ETF. It is a component of SSK, which is the Rex Shares product.
I was going to ask you about that. How is that being used? Do you want to elaborate on that?
Yeah, so SSK, I think people in your your listeners are probably going to be more familiar with some of the nuance behind that sort of listing process than others. Because RexShared filed that as a 40 Act, they essentially were able to list it without the SEC's approval, without going through this 19B4 process. But they, so kudos to them. They've got in excess of 200 million AUM. It's obviously a product that investors wanted, and I think the market is demonstrating that they appreciated RexShare's efforts to get this listed. The main difference between the RexShares product and the suite of Solana ETFs that are in filing now is, so RexShares is filed via 40 Act, and it's also structured as a C Corp, whereas the other kind of filings are via the 33 Act or are structured as grantor trust, which means that because it's a C Corp and because it's 40 Act, the C Corp means that there's some adverse or unfavorable tax treatment to the assets that are under the fund right now. And they've recognized this. Like they're in the middle of filing for a conversion from a C Corp to another structure. And under the 40 Act, there are provisos under the 40 Act where they have to hold a certain amount of their assets in securities. And weirdly, because JitoSOL was not a security, they couldn't actually increase the amount of JitoSOL that they held. And so it's treated as not, in the current structure, it's not treated as a principal investment, which means that there's a cap to the amount of JitoSOL that they can hold. But that's part of the reason why SSK holds the 21 shares product, is because they needed to hold something like 40% of their assets in a security.
In terms of staking within ETFs, I want to go back to a comment you made around IRS guidance here. And I think clearly that's been one of the areas that's been holding up these ETFs from coming to market. Now, my understanding is that should not preclude the SEC from approving these. Theoretically, the SEC could approve these, but issuers still may not be able to engage in staking within the ETF until they get that clarity from the IRS. And my question for you is, you mentioned that liquid staking tokens like JitoSOL, excuse me, those are total return products. And so I just want to be clear for people listening here, that's essentially why that's not an issue with the IRS, because the liquid staking tokens aren't kicking off that income, right? It's baked into the product. Is that a good way to think about it?
So this is not
no tax advice on this podcast, by the way, or tax guidance.
Yeah, not tax advice. It remains to be seen what the IRS decides to do. We do take the view that because it's a total return product, and so we released a tax report from Fenwick. This was a few months ago now, which made two very important claims about LSTs. One is that if you mint an LST, you weren't locking in the cost basis on the underlying SOL. So the minting of the LST is not a taxable event. That's a big deal for like if you bought in the kind of Solana mint and have just been sitting on unstaked SOL. Like, is there any tax implications if you minting JitoSOL? And the answer is no. The second is that staking rewards should be viewed as newly created property, not income. And the important nuance there is that newly created property are taxed on disposition or sale, not at the time that they are paid. And I do think that the total return products are probably cleaner from a tax perspective, mostly because, like, if you look at something like Steve, which is the Lido staked ETH product, so that has this property where it's considered a rebasing token, and it's pinned to, like, one Steve is roughly equivalent to one ETH, but you just receive more Steve, and so you're getting what looks like a distribution, and that from a tax perspective, if you're actually just getting more stuff in your account, like it does look like a distribution that is potentially taxable. Whereas if you hold one JitoSOL today, it's worth, say, 1.23 SOL. In a year from now, it's worth 1.3 SOL. But you still just have one JitoSOL in your account. That looks kind of cleaner from a tax perspective. And again, similar to an ETF, like you're creating JitoSOL physically in kind using Solana, and getting redemptions physically in kind. And so from a tax perspective, like we think that these are pretty efficient from that standpoint.
Intuitively, that certainly makes sense to me.
Yeah, but we'll see what the IRS says. But
We
I agree
will.
with your point that the SEC, like hypothetically, the SEC could approve these, and then the IRS could come out with a ruling. But I know that there's a number of people in the industry who is pushing the IRS for guidance. I think POSA, which is the Proof of Stake Alliance, has been very active on this point, and there's a lot of people kind of behind the scenes. Certainly we are part of a group of people who kind of are reaching out to people, on the task force and who to push for some sort of clarity, because we understand that this is a pretty big gating factor right now.
Another area that I imagine the SEC is taking a hard look at as it pertains to something like JitoSOL, and you touch on this briefly, is just secondary market liquidity.
Mm-hmm.
What does that look like for JitoSOL, for people unfamiliar with this?
So that's a very, very good question. And so I think that there are very different considerations if you consider like it from a retail perspective versus an institutional perspective. So from a retail perspective, like JitoSOL is the most liquid staking token on Solana. It's also the biggest on Solana. And so if you look at the number of centralized exchange listings, the number of DEX listings, the spreads and the volumes, like JitoSOL kind of rates very well on all of those metrics, especially relative to other LSTs. But if you're from an institutional perspective, this is a concern. Like if we're going to do a very large redemption in JitoSOL, like let's say you want to redeem 200 million of JitoSOL, what sort of impact does that have? And what we tell people is that, again, I hate to kind of harp on the ETF example, but this actually shares a lot of properties with other kind of ETFs. And so the argument that is made in ETF land is, let's say you're an issuer, you create a basket. And let's say the basket is, whatever, it's a sector basket or it's an emerging market basket. And so you launch the ETF and you have a lead market maker. You need a lead market maker in order to get these listed on exchange. So the lead market maker is kind of obligated to post certain size markets at certain sorts of spreads. And if you were to look at the liquidity, the on-screen liquidity, and only see the market maker quote, then you might conclude that, this is a very illiquid product. But I think what people in ETF land kind of grok very kind of intuitively is that the true liquidity of an ETF is the liquidity on the underlying basket, not on the lit liquidity of the ETF itself. Because if you took this sector basket or this emerging markets basket and you wanted to do a $100 million creation, what you would do is you would not buy this on screen. What you would do is you would go to like a market maker, an AP, or an OTC dealer and ask for a price. And the price that you would get would be based on the impact of that order on the liquidity on the underlying basket. And the reason why this is true is because there are firm enforceable arbitrage bounds that keep an ETF in line with its holdings. And JitoSOL has the same property. JitoSOL mints are free and they're instantaneous, and the burns cost 10 basis points and get unbonded at the end of every epoch, which are roughly 2 days now. And the 10 basis points, by the way, is not like a fee that we collect. It's actually to prevent certain types of gaming that is available to people if mints and burns of LSTs are free. So the lowest discount that JitoSOL should trade to Solana is 10 basis points plus 2 days cost of capital. Now, cost of capital can mean a lot of different things, but if it trades below that arbitrage bound, we believe that there are, and we've gotten assurances from some of the largest trading firms in the world that they would be willing to step in, because this is a self-interested, this is just an economically rational trade. And because there are a number of large and well-capitalized firms who are looking at these pairs, we suspect that there will be a lot of competition if all of a sudden JitoSol traded, 50 basis points below Solana. And so the existence of these arbitrage bounds means that if you were to, means two things. One is, if you want to get a price on a large slug of JitoSol, the way that everybody would do it is they would go to an OTC dealer. And the OTC dealer would show them a price relative to the price impact on Solana itself, plus some spread on execution costs and cost of capital and funding, things like that. The other is, if JitoSol started trading outside of arbitrage bounds on any centralized exchanges, you would see liquidity fill in very, very, very quickly. And so, in some ways, the absence of trading volume is evidence that JitoSol is trading in line with the arbitrage bounds.
So is there any size that, say, the VanEck JitoSol ETF could become? Let's say it gets to $10 billion in assets, and then there's some market stress, people want to sell, get out of Solana. Is there any size that the ETF could become that would give you cause for concern? Or because of what you just described, you think that there are enough players in the ecosystem to be able to arbitrage? Just how you described how an ETF works, that wouldn't be a concern. Anytime you have market stress in any asset class, right? You can have some dislocations. You can have ETF, for example, trading at discount. So that's not necessarily abnormal. But what I'm really talking about is just the actual functioning of the ETF itself.
Yeah, sure. That's a great question. And I think the answer is that the absolute size is not actually the relevant factor. It's the relative size. And so I think the FDV of Solana right now is 125 billion. And so if JitoSol was a very meaningful percentage of that, potentially there is some sort of there might be some kind of net, some adverse impacts if JitoSol was a very significant percentage of total Solana FDV. But even if the Solana market didn't change at all, and JitoSol, the VanEck JitoSol ETF was 10 billion, you're still talking about 8% of the FDV in Solana, and it's still something that I think is reasonably manageable. But the key thing here is that the thing to understand about a JitoSol ETF, and this kind of feeds into the JitoSol versus the StakeSol ETF, is that the JitoSol ETF gives issuers and APs more flexibility, because if there's a large redemption, there's more options. You can just do the JitoSol redemption in kind. There's no need to go out to the market and just kind of sell a bunch of JitoSol. But the other thing is, if you have JitoSol as a constituent of your ETF, you can either wait for it to unbond. And if you think about this, so let's say for Solana epochs are every 2 days. And so if you think about the business cycle of ETFs, you're actually just talking about 40% of days where the unbonding might become an issue. And so essentially the idea is if all the days are normally distributed and the epochs are distributed across all the days, essentially there are two, any redemption that comes in on Friday, you could just meet by unbonding the Solana and delivering it out on Monday. So that's always going to be true. And so there's basically 2 other days in the week where you don't have the ability to unbond and then just deliver out the ETF. So with JitoSol, you can unbond the same thing as with the staking provider. And the other thing is, if you need liquidity, particularly on a cash redemption, what JitoSol offers that native staking doesn't is that you can sell the JitoSol for SOL. So the JitoSol/SOL market should just be kind of monotonically increasing as the number of SOL within the product increases. And so that should be a very, very, very low vol pair. That would be very easy to trade. And so that's not something that you can do with like native stake. You can't just sell staked SOL, but you could do it via an LST.
Real quick, before we move on, because I do want to ask you about Solana itself, are there any other potential risks with JitoSOL compared to direct SOL exposure? Like you'll hear people talking about, well, what happens if the smart contract is exploited or something like that? Are there any risks that investors should be thinking about here?
Sure. I mean, smart contract risk is real. We've had a number of audits. So Jito has been audited 9 times, once on the smart contract itself. So yeah, the technology could certainly be an issue. I mentioned earlier this whole, the differences on staking between Ethereum and Solana. And one of the things that we are seeing now on Ethereum today is, so Ethereum has a limited amount of stake that can be unstaked or staked. This is true both ways on Ethereum in any given block. And so what ends up happening is if there is a large amount of redemption requests or burn requests, they get added to a queue, which extends the amount of time that it might take for you to receive your assets back, your Ethereum back. And so I think we saw it expand out to maybe 3 weeks earlier. I think it might be at 2 weeks today. Everyone should do their own research. This is just what I saw on Twitter today. But what that means is that there is some potential. But what I think we saw, at least when it came to something like Steve, is that it experienced what looked like to people as a DPEG event, which is that Steve traded below ETH. But actually, if you look at it, so the discount that it traded to relative to ETH, I think was an expression of the cost of capital out to the time that the unbonding would actually take place. And so when he talked about like the discount that Steve was trading to ETH, it was not on the order of percents. It was on something like 30 or 40 basis points, which if you think about like the cost of capital out to 2 or 3 weeks, is actually a pretty good interest rate. So there's some chance that you cannot access, your Solana for some reason. Let's say, there's a delay in the end of an epoch or something like that. So there's some potential like discounting to when the SOL is released. But at this point, Solana has been very, very high functioning and growing quickly. And there haven't been any issues for over a year and a half, I think, or a year and a half. And so, yeah, there are risks to any investment. Yield is not free. Like it carries some, you have to be aware of where the risk comes from. And in this case, the yield is just kind of the native Solana emissions rate plus, the network activity.
A few minutes left here. Let's close with your thoughts on Solana itself. And I actually discussed this a little bit on the podcast last week, but I'd love to hear how you view the investment case here. Why should investors consider owning SOL or having SOL exposure to begin with?
Yes, this is the $1 billion question, right? Like, and this is particularly relevant when it comes to the ETFs, because one of the things that we've heard from like multi-asset issuers is how do we get our sales force to sell Solana? Like we're trying to sell like the whole universe of equities and fixed income and FX and commodities, ETFs. Like what is the investment case for Solana? Like how should we be trying to sell this? And how do we get our sales force to actually understand this? And I think it still was a problem for Ethereum and still may be a problem for Ethereum, though Ethereum seems to be kind of generating a much more kind of valid investment thesis over the last few months. And so it's something that Solana needs to work on. The way that I view it is, Solana has this relentless focus on improvement. And the improvement in Solana's case, is always on the technology. So you hear a couple of kind of buzzwords, like one is IBRL, which is increase bandwidth, reduce latency. There is a lot of work that is being done to like increase the capacity. There was just a recent change which increased the amount of what's called CU or compute units by 20%. There's a project called 00 that is repurposing like existing fiber networks to reduce the latency on the network itself. And so there is on Solana a huge focus on making the tech more usable. And what we're seeing is that a lot of high throughput activity kind of naturally gravitates to Solana. And that's part of the reason why by active user count and app revenue and, by every sort of metric that rests on kind of frequency of transactions, they all tend to gravitate towards Solana. And so I do think that, if I can belabor another kind of metaphor here, I think that if you think about blockchains in general, like I think there's pretty good consensus in terms of what the direction of travel is. Like, regardless of the blockchain, everybody is heading towards a world where more transactions are happening on blockchains as opposed to kind of off-chain. And so, you do have this sort of situation where, like I grew up playing a game called Oregon Trail. And, the whole premise of Oregon Trail is like you had to make it out west. And I do think that if you look at the history of kind of how the West was developed, there were lots and lots of different ways to get there. And a lot of, the choices that you made depended on your utility curve, like whether you took a stagecoach or whether you, built roads or you built railroads or whatever. And I do think that ultimately the services that are built tend to aggregate to the most convenient path. And so, for a long time it was, railroads were hard to build. It required a lot of investment. It required a lot of people to build. But once they were built, then commerce, like postal services, mail order, like a lot of that stuff just tended to naturally flow to the path of least resistance. And so I think if you're a blockchain, you can choose whether or not to build for the use cases that exist today or invest in the infrastructure that allows you to support the use cases to come. And I think Solana very much is well positioned to provide the services that are coming in the future. And we're seeing evidence or hints of it right now. Like, Galaxy just tokenized stock on Solana using Superstate. And, if you are going to achieve this state, another kind of goal, stated goal of Solana is like a decentralized NASDAQ. If you are going to support that level of transaction volume, you just need to have the infrastructure in place. And that's not something that you can build like ex post. So I think the investment thesis for Solana is, it is the blockchain that is preparing for a world where everything is conducted on chain.
I love the Oregon Trail analogy. I have fond memories of playing that, though I died way too many times. I don't think I made
Dysentery.
it out west. Yeah, the dysentery every single time. Let me ask this before I let you go, and I think with your analogy, this is clear, but I'd love to have you just articulate this. And I talked a little bit about this last week where one of the guests said they view, we have all of these chains out there. And the question that I posed, is it winner take all? And their response was, it's winner take most. How do you view that? Because you have all these competing blockchains. I made the point that, for better or worse, I'm out on X or Twitter, and it's amazing to me how tribal the different crypto factions are. And I mention that because when you see that tribalism, it would lead you to believe that the way that these independent or these individual ecosystems view the world is that it is winner take all, that you have one chain trying to kill off another. So how do you think about that?
Yeah, so I'm not a huge fan of the tribalism. I think that like it's still, and I know that we've been all saying it for years, but it's still so early. And the whole idea of like counting balls and strikes like in the first inning of a game or second or whatever analogy that you want to use, like it's just not that meaningful. And I think the real goal for anybody who is working in the space is just focus on growing the pie, like in whatever way that you can, like whether or not you make the services more robust, or you create an app that attracts users, or you kind of figure out a service that makes everything just work better, more efficiently, and reduces the frictions for entry. Like, regardless of what chain that you're building on, like growing the user base of kind of crypto and decentralized services is the goal. And we can all kind of argue over like the slices of, the way that the slices of the pie are cut later. I think right now, like we're just all, I mean, we're rowing in the same direction, much more than we're kind of fighting against each other. And so, you know, people need different things to motivate them, and that's fine. But fundamentally, like we all have the same goals. Now, when it comes to like which technology is going to win out, I think the technology that's going to win out is the one that actually abstracts all this away for the users. And so, like, I, I, I think a great and beneficial steady state, and again, I think this is true for not only everybody in the industry, but also kind of the world, is if people are doing the things that they want, are engaged in the economic activity that they want to pursue, and don't actually know like what the underlying blockchains are, because the UX will have improved to such a way that everything is just smooth. And so, I don't think it needs to be a situation where winner takes all, because the size of the market that we're talking about is just so small right now. Like, crypto is a $4 trillion asset as in aggregate, something like that right now. But NVIDIA as itself, as a company, is 4.5 or something like that. Like, if you're talking about the global equities market, if you're talking about the global fixed income market, like this is just a very, very, very tiny piece. Like the growth of the industry is going to come from like ubiquity and ease of use and UX and all of these things. And so, I think Solana is well positioned because, like I said, I believe that services will kind of flow to the path of least resistance. But there's a very, very kind of viable world where there's multiple blockchains that are being used. Some are permissionless and some are permissioned. Like there are very different use cases for, depending on whether or not you care about privacy, or whether you care about like stablecoin liquidity, or whether you care about, collectibles, or, whatever it is that you care about. I think we're all on board with saying that whatever it is, whatever sort of economic activity you like to engage in, blockchain probably has a way of making it easier and faster and cheaper and more reliable and all this other stuff. And that's really what we should focus on. Like, how do we make things easier to onboard the next kind of billion users than figuring out, like, whether or not your chain is better than mine at, capturing a very, very, very small slice of the market. Like,
I'm not sure I could have said it better myself. To sort of close with a poor analogy or metaphor, it's a rising tide raises all boats, right?
100%.
And if each chain focuses on what those real world use cases are and improving the user experience and building something that people actually want, all of the other stuff goes away. The pie grows really big, and the chains that do that well, they'll have a piece of that pie.
Yeah, and we'd all be better off, both as users and as participants. And that's
But it
all
wouldn't
right.
it wouldn't make as fun of a Twitter experience. So saying the back and forth, but
And then Twitter will find new ways to entertain itself.
No doubt about that. Thomas, this has been such a great conversation. I love that we were able to deep dive into some of the plumbing, really in ETFs, but also behind the scenes in the crypto market. So excellent conversation. Thank you for joining me.
Yeah, it was a pleasure. Keep up the great work.
Thank you. That was Thomas Chief Commercial Officer of the Jito Foundation. Hope you enjoyed this episode of Crypto Prime. I want to thank our sponsor, Tuttle Capital. If you would like to learn more about Tuttle Capital's ETF lineup, you can visit TuttleCap.com. For exclusive daily market insights and the playbook that Wall Street doesn't want you to see, subscribe to Tuttle's free newsletter at theheatformula.beehive.com/subscribe. See you again next week.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. Some guests appearing on this program may also be financial sponsors of Crypto Prime. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.